Imagine, just for a second, looking out at the financial skyline of a major city right now in 2026. The most critical infrastructure supporting all of it, it isn't made of steel or glass, and it's definitely not housed in the marble columns of a traditional central bank.
Right, it's completely invisible.
Exactly. It's constructed entirely out of cryptography, game theory, and collective agreement. I mean, it holds trillions of dollars in value, executes thousands of complex agreements every second, and there's no landlord holding the master key. It just operates relentlessly on these unbreakable digital rules.
Yeah, and it's a profound shift in how we even conceive of economic architecture because, well, we've spent centuries building physical and institutional structures to enforce trust, right?
Yeah, definitely.
But now we are looking at mathematically secure environments that are so rigid, they completely alter the foundational dynamics of how firms compete and, honestly, how society organizes itself.
Which is exactly why we've put together this custom-tailored deep dive for you today. We have a massive, and I mean really dense, stack of sources to go through.
It is quite the stack, yeah.
Our goal here is to uncover what is quietly rewiring the global financial system and our civil society. We're drawing from some cutting-edge National Bureau of Economic Research working papers, specifically the research of Cornell's Lin William Kong. Plus, we're integrating progress reports from the Stanford Center on Philanthropy and Civil Society, industry outlooks from State Street and the PwC, and on-the-ground impact assessments from the Blockchain for Good network.
And just to be clear, our mission here is to completely filter out the retail crypto speculation noise.
Oh, please, yes.
We aren't talking about meme coins. We are analyzing the actual economic architecture of the fintech revolution as it stands right now.
Okay, let's unpack this, because before we get into the really flashy stuff like institutional tokenization or, digital civil society, we have to look at the engine block of this entire system, which is decentralized consensus.
Right, and the breakthrough there isn't just the distributed ledger itself. I mean, distributed databases have been, enterprise staples for decades at this point.
Sure.
The real paradigm shift is decentralized consensus paired with smart contracts. This mechanism allows completely divergent, even adversarial agents to agree on a single state of truth without relying on some centralized clearinghouse. It effectively automates trust at the protocol level.
I like to look at this through the lens of George Ekerloff's classic lemons problem.
Oh, that's a great analogy.
Yeah, because the implications for market entry are massive.
Yeah.
Usually a high-quality new business, they struggle to prove they aren't a scam, a lemon, because buyers have asymmetric information.
Right, the buyer just doesn't know what they're actually getting.
Exactly. And historically, businesses solve this by spending, millions building brand reputation or relying on really costly escrow services. But with a smart contract, you structure the sort of algorithmic escrow. Think of it like an unbribable, indestructible digital vending machine.
I love that.
The payment is locked, and it's only released upon verifiable delivery. The new entrant doesn't need a decade of brand equity, right? Because the cryptography guarantees the execution.
Yeah. And that is definitely the utopian view of automating trust. But the NBER research introduces a really fundamental tension here.
So what kind of tension?
Well, to achieve that decentralized consensus without a central validator, the state of the network has to be verified by multiple nodes. And this requires what they call an irreducible distribution of information.
Right.
In other words, to make the trust algorithmic, you are mathematically forced to create radical transparency across the record keeper.
Wait, I have to challenge the idea that this is inherently problematic.
Sure, go ahead.
In traditional financial markets, we generally treat opacity as the enemy.
Right.
Like the SEC mandates disclosures specifically because transparency is supposed to ensure fair pricing and, protect consumers.
Yeah.
How does this irreducible transparency backfire?
It backfires heavily when we apply it to the theory of industrial organization. In a highly transparent market, perfect information is actually a cartel's greatest asset.
Oh, wow.
Yeah. In traditional markets, tacit collusion-like price fixing among a few dominant firms, it's notoriously unstable because someone usually cheats.
Right. They secretly lower their prices or offer some back-channel discount to steal market share.
Exactly. And then the cartel breaks down because the competitors can't monitor every single transaction their rivals are making.
Ah, I see where this is going.
Yeah. On a public, completely transparent ledger, a dominant coalition can monitor the pricing and output of all its competitors in real time. If any firm deviates from the collusive agreement, the cartel detects it instantly.
And they can punish them.
Yes. They can even use smart contracts to algorithmically trigger a price war to punish the deviator the second it happens.
So the very technology designed to circumvent massive centralized monopolies, it actually provides those exact entities with the ultimate surveillance and enforcement mechanism to maintain a cartel.
That is the dark side of decentralized consensus, yes. And the takeaway for regulators looking at this research is that to protect competitive privacy, you must enforce a functional separation between the consensus record keepers and the actual users.
Or what? The transparency just ruins the market.
Basically. Alternatively, developers have to inject mathematical noise into the data using mechanisms like zero-knowledge proofs. That way, the nodes can verify a transaction is valid without actually seeing the competitive pricing data. If you don't engineer that privacy, the transparency just destroys competition.
That sets up a totally fascinating structural paradox. I mean, if the underlying protocol requires such a delicate balance of cryptographic privacy and public validation, how do these networks bootstrap their growth in the first place?
Yeah, that is the million-dollar question.
Right, because a network with no users has no utility, regardless of how elegant its consensus mechanism might be. And I think that brings us to the mechanics of tokenomics.
Yes, tokenomics. And to understand it, you kind of have to discard the traditional discounted cash flow models we use for equities.
Because there's no cash flow.
Exactly. Utility tokens on a digital platform don't generate dividends. The NBER working papers show that they derive their equilibrium value from the aggregate transactional demand of a really heterogeneous user base.
Here's where it gets really interesting. Because the adoption of these platforms typically follows a logistical S-curve, right? And the sources highlight this concept of intertemporal complementarity.
Yes, that's a crucial piece of the puzzle.
If I'm an early adopter evaluating a new decentralized network, I'm not just assessing its utility today, I'm injecting capital because I expect the token's value to appreciate as the network effects compound tomorrow. It's this fusion of the transactional motive and the investment motive.
And this fusion creates an unexpected macroeconomic property for the network, which is built-in shock absorption.
How so?
Intuitively, you would think that if a platform suffers a negative productivity shock, say a protocol upgrade introduces a bug, or there's a sudden regulatory crackdown, the user base would just collapse. But the token price volatility actually dampens the user base volatility.
Let me trace the mechanism on that, just to make sure I'm following. So if the network takes a massive hit, the utility drops, causing some users to just liquidate their tokens and leave,
Right.
which drives the token price way down. But for the users who remain, their expectation of future returns just shifted, right?
That's the exact mechanism.
Yeah.
As the token price drops due to the shock, the cost of entry for future adopters falls, and the potential upside for the remaining users actually increases.
Oh, well, that makes sense.
Yeah, the remaining users tolerate the temporary loss of utility because the mathematical expectation of future token appreciation has steepened. The token price absorbs the brunt of the shock, allowing the core user base to stabilize and wait for the network to recover.
But, and this is a big but, if the entire valuation architecture relies on aggregate transactional demand and these expectations of future growth, we run into a major vulnerability. How do we know the demand is actually organic?
Wash trading.
Exactly. Wash trading has historically plagued these networks. You have insiders just trading back and forth with themselves to simulate volume and trigger that investment motive in unsuspecting retail buyers.
It's a critical issue. And Lin William Kong's team analyzed transaction data across 29 different crypto exchanges to differentiate organic volume from synthetic manipulation. And what's cool is, instead of looking for crude bot signatures, they applied natural statistical laws.
Specifically Benford's law.
Right.
And just for a quick refresher for everyone, Benford's law dictates that in naturally occurring datasets, the first significant digit isn't uniformly distributed. The number 1 appears about 30% of the time, and it drops logarithmically from there.
Exactly.
But wait, why wouldn't a sophisticated watch trading algorithm just be programmed to mimic a logarithmic distribution? That seems pretty easy to fake.
You'd think so, and that is the genius of the research. While a single bot could easily be programmed to spoof a Benford distribution for a specific asset, wash trading at scale across an exchange involves multiple interacting algorithms.
Right. They're all trying to hit specific volume targets at specific times.
Yes, to maintain this grand illusion of liquidity. And when you aggregate all that synthetic activity, the emergent distribution flattens out into a uniform or normal distribution. It mathematically fails the lie detector test because the constraints of faking volume override the natural logarithmic variance of organic human trading.
Wow. So you can fake the marketing and you can fake the volume metrics on a dashboard, but you absolutely cannot fake the underlying statistical entropy of organic market behavior.
Precisely.
And deploying these kinds of rigorous diagnostic tools is exactly what facilitated the transition we are seeing right now in 2026. A market has completely matured past the retail speculation phase. We are firmly in the dawn of the institutional era.
We really are. The institutional outlooks from State Street and PwC, they present a staggering shift in capital allocation. Over 86% of surveyed institutional investors are currently allocating to digital assets.
86%, that's huge.
It's massive. And projecting forward to 2030, these institutions expect between 10 and 24% of their total portfolios to execute via tokenization.
And when we talk about institutional tokenization, we aren't talking about some hedge fund holding Bitcoin in a treasury. We are talking about the fractionalization of massively illiquid markets.
Right. The real-world assets.
Yeah, take the $1.5 trillion private credit market or commercial real estate. Historically, these assets suffer from massive illiquidity discounts because transferring ownership of, say, a $100 million commercial skyscraper, it requires months of legal friction.
And a mountain of paperwork.
Exactly. And it limits the buyer pool to massive funds. But by tokenizing the asset, you break it down into digital Lego bricks. You represent ownership on a distributed ledger, allowing anyone to instantly buy, sell, or trade a single fractional brick with the same liquidity profile as a publicly traded equity.
The liquidity premium is definitely one factor, but the true driver of this institutional adoption is operational efficiency, specifically atomic settlement.
Break that down for us.
Sure. So if an institution wanted to move capital across borders using the legacy SWIFT network, it involved routing through multiple correspondent banks, each one maintaining their own separate ledgers that had to be manually reconciled.
Which introduces counterparty risk and takes days.
Exactly. But with tokenization on a unified ledger, the transfer of the asset and the settlement of the payment aren't sequential steps anymore. They are the exact same event. Atomic settlement means it executes in a single protocol state change.
Near instantaneous.
Yes, and by retiring legacy systems like ACH and the traditional DTCC clearing processes for these specific asset classes, the industry is capturing an estimated $12 billion in annual operational savings.
$12 billion. That is a wholesale upgrade of the global financial plumbing.
It really is.
But this programmable infrastructure is not confined to just capital markets and Wall Street. It is spilling over into our civic lives, creating a brand new layer of social infrastructure. And the Stanford Center on Philanthropy and Civil Society, or Stanford PCS, they map out how this technology creates what they call fractional institutions.
Yeah, a fractional institution emerges when a decentralized ledger allows communities to completely bypass failing or hostile traditional institutions. Because blockchains are immutable and theoretically censorship-resistant, marginalized populations are using them as archival institutions.
Let's ground this in the physical world for a second. Consider a refugee fleeing a regime. They lose access to the state apparatus that verifies their identity, their academic credentials, or their property rights.
Right. They essentially become undocumented overnight.
Exactly. So the concept here is that a decentralized network provides a portable identity document that a hostile state cannot revoke. But I see a massive oracle problem here. How does a person with no physical documentation prove who they are to a blockchain in the first place? I mean, the blockchain only knows what it's told.
And the oracle problem is the central bottleneck here. The blockchain can secure the data perfectly, but it can't verify the physical truth of the data being uploaded. To solve this, these fractional institutions are relying on community attestation protocols, or decentralized identifiers known as DDs.
How do those work in practice?
Well, instead of a government issuing an ID, a web of trusted local actors like NGOs, community leaders, or aid workers, they cryptographically sign assertions about an individual's identity. The blockchain then aggregates these attestations into a verifiable credential. It's essentially decentralized trust bridging the physical to digital gap.
That is incredible. And we see that same bridging mechanism applied to global aid, too. The Blockchain for Good reports analyzed deployments across 12 distinct sustainable development areas, plus a 13th that's actually dedicated to evaluating Bitcoin's environmental footprint.
Which is a whole other debate.
Oh, absolutely. But in philanthropy, smart contracts fundamentally alter the disbursement of aid. You program the capital so it remains locked in escrow until verifiable, on-the-ground impact metrics are fed into the network by trusted oracles. You essentially bypass layers of administrative bloat and mitigate local corruption entirely.
It's powerful. However, the Stanford research issues a really severe warning about this civil integration. In the book System Error and Through Their Dark Patterns tip line, researchers highlight the friction between big tech's optimization mindset and fundamental human values.
Yeah, this is where the utopian narrative of decentralized finance, or DeFi, hits a brick wall. The tools are explicitly designed to be liberating, but the Stanford analysis shows that the social and technical layers of these networks often replicate the exact wealth concentration of traditional finance.
What's fascinating here is how the governance structures fail. Many DeFi protocols are managed by decentralized autonomous organizations, or DAOs, where voting power is purely proportional to the number of governance tokens you hold.
Which sounds democratic in theory.
In theory, sure. But in practice, early venture capital backers and massive whales accumulate a monopolistic share of the voting power. They end up controlling the protocol upgrades and the yield structures.
So we are dealing with a system that removes the highly regulated Wall Street banker and just replaces them with an anonymous group of algorithm writers who hold entirely disproportionate governance power.
Essentially, yes.
And because the system is permissionless, it allows for the deployment of dark patterns, which are these deceptive smart contract designs. If a user isn't fluent in reading code, they might authorize a transaction that mathematically exploits them. And because the ledger is immutable, there is no customer service hotline to reverse it.
Which is exactly why civil society organizations have to actively monitor and audit these structures. And honestly, it brings us to how this complex architecture is actually being interfaced by the average user today.
Because the average person isn't interacting with raw smart contracts.
No, not at all. They are interacting with the convergence of blockchain, AI, and digital e-wallets.
Let's dig into that consumer layer. The sources point to the massive expansion of e-wallet super apps and buy now, pay later, or BNPL, credit models. There is a prevalent assumption out there that BNPL simply traps lower-income consumers in cascading debt spirals, much like predatory payday lending.
That's the common fear, yes.
But the research suggests it's functioning more like digital cash for high-frequency, small-ticket transactions. It expands credit without necessarily triggering massive default waves. How is that possible?
The reason BNPL hasn't triggered catastrophic default rates within these super apps is due to the architecture of the ecosystem itself.
Right.
Think about it. Traditional credit cards monetize user failure, right?
Yeah.
They rely on late fees and compounding interest.
Right.
But a super app integrates messaging, ride-sharing, food delivery, and daily payments into a single interface.
So the enforcement mechanism isn't just a hit to your credit score.
Exactly.
If you default on your BNPL installment within a super app, you risk being algorithmically locked out of your daily transportation and communication infrastructure.
Which is huge.
Yeah, the cost of defaulting is incredibly high in terms of daily utility, which enforces strict behavioral discipline.
Precisely. The platform leverages its panoptic view of the user's daily habits to underwrite the risk. But managing and parsing that immense volume of behavioral and transactional data requires artificial intelligence. And if an AI is making real-time credit and liquidity decisions, it absolutely cannot be a black box.
And this is a critical point from Lin William Kong's research. Historically, machine learning in finance relied on deep neural networks that were incredibly accurate but entirely opaque.
Right. Nobody knew how they arrived at their conclusions.
Yeah, the algorithm might find some spurious correlation in the data that works fine in a bull market, but when the macroeconomic regime shifts, the black box just blows up because it has no foundational understanding of actual economics.
To solve this, Kong's team pioneered what they call goal-oriented, economically guided AI, utilizing architectures like structured knowledge-informed neural networks or skins and panel trees.
I really want to break down exactly how a skin operates differently from a standard model, because instead of just throwing raw data into a hidden layer and letting the machine guess, you are mapping the neural nodes to specific economic variables. You are introducing regularization terms derived from actual asset pricing models.
Precisely. You penalize the model during its training phase if its predictions violate fundamental economic axioms.
Like what?
Like the law of demand or arbitrage pricing theory. By hard-coding these theoretical guardrails into the network's loss function, the AI is explicitly prevented from chasing statistically noisy correlations. It makes the model remarkably stable and interpretable, even during periods of extreme market volatility.
That's brilliant. But, even with economically sound AI and perfectly immutable ledgers, there's a physical world limitation that really caught my attention in the sources. The Green Shield action in China serves as this phenomenal case study of what happens when perfect technology meets imperfect human policy.
Oh, the sustainability paradox. Yeah, the Green Shield action utilized blockchain infrastructure to monitor industrial emissions, and on a purely technical level, it was a total success.
The sensors worked perfectly.
Right. The IoT sensors fed data directly to a transparent ledger. The emissions were tracked immutably, effectively eliminating the ability of firms to submit fraudulent environmental reports or bribe local inspectors.
Yet the overall environmental outcome wasn't a net positive. It created what the literature refers to as a partial adoption equilibrium.
Yes, because the blockchain implementation was only enforced in specific jurisdictions. When the worst polluting firms realized they could no longer manipulate the monitoring system, they calculated the cost of upgrading their facilities to comply with the emission standards versus the cost of simply relocating.
And they just moved.
Exactly. Many chose to pack up and move their operations to regions that had not adopted the blockchain monitoring.
So the transparency of the ledger didn't eliminate the negative externality at all. It just geographically displaced it. The technology worked exactly as designed, but the problem simply migrated to a regulatory blind spot. So what does this all mean?
It illustrates that the efficacy of decentralized technology is entirely bounded by the jurisdiction of its implementation. An immutable ledger, or a perfectly rational AI, cannot solve a coordination failure if the underlying policy isn't universally applied. Technology just rearranges the incentives. It doesn't override human nature.
That's a perfect summary. We have mapped out a massive shift in the global infrastructure today. We started by dissecting decentralized consensus, looking at how the radical transparency required to automate trust can inadvertently hand cartels a perfect surveillance tool. We examined the tokenomics that bootstrap these networks, where the expectation of future returns absorbs the shocks of today, and how natural statistical laws can expose manipulated volume.
We also tracked the maturity of the space into the institutional era, where atomic settlement is generating billions in savings and fractionalizing historically illiquid private markets.
And finally, we saw how programmable money is reshaping civil society. From refugees utilizing fractional institutions for identity, to the super apps and economically guided AI dictating daily consumer credit, all the way to the jurisdictional limits of tracking industrial pollution.
It really is a profound evolution. We are moving from institutions reliant on human discretion to systems governed entirely by cryptographic certainty.
Which brings us back to that invisible skyscraper we pictured at the start of our deep dive. A structure built of pure mathematics, frictionless and relentlessly efficient. It executes without bias or fatigue. But I want to leave you with a final thought to mull over, one that stretches just a bit beyond the data in our sources today.
Go for it.
If we are rapidly building a society where our financial wealth, our legal agreements, and our civic identities are bound to programmable smart contracts, executing automatically the exact millisecond a mathematical condition is met, who ultimately holds the power to hit pause?
That is the ultimate paradox of algorithmic trust. If a perfectly efficient financial machine never sleeps, does it also permanently forget how to forgive a debt? In the pursuit of total systemic optimization, do we engineer out the capacity for human grace during a crisis?
Is total rigid efficiency truly what we want to serve as the bedrock of our civil society? Something to consider the next time a super app seamlessly approves your transaction. Thank you for taking this deep dive with us.